I'm excited to introduce my friend and my CPA, Eric Freeman, as an official KenMcElroy.com advisor. Eric and I have been working together over the years, and he's personally helped me with the 1031 exchanges, partner buyouts, cost segregation studies, and many, many other complex transactions. Not only is Eric great at what he does, but he's also able to break down very sophisticated subjects and make them very easy to understand. I've learned a lot from Eric, and so will you. You'll see a lot of videos featuring Eric's expertise on YouTube in mini courses and in my premium membership. Eric, welcome to the KenMcElroy.com family.
Welcome back, everyone. There's been a lot of talk with any new administration. We're always looking at the new tax proposals. So today we're going to look at some of the proposals that really we had learned about these back in December and earlier on during the election, and now we actually have them in proposal form, and so some of these are actually likely to happen. So today I'm going to cover 5 of the big ones that may affect real estate in general. Of course, there's a lot more to unpack than this, so I encourage you to reach out to your CPA or other advisor if you think there may be something that will affect you. So the first one that we're going to talk about is the ordinary income rate. So this is income from things like your wages, maybe it's from interest or other types of investment income. They're all going to be taxed at this ordinary rate. Currently, it's 37%. The proposal is that we would increase this now to 39.6. Doesn't seem like a lot, a little under 3%, but along with some of the other changes that we could see, it's going to really start to make a big difference. The next big change is that to capital gains rates. So right now, capital gains, just real briefly so we understand this, is when you hold an asset for more than 1 year and you sell it, you receive this preferential tax rate on that income. So instead of paying the ordinary income tax that we just described in the previous slide, you may get taxed at either 0%, 15%, or 20%. 20 being the highest one that we're looking at right now. Now, what they want to do, or at least the proposal that's currently floating out there, is that they would increase it to a top rate of 25%. So this could have a big effect if you're thinking about or already in a transaction to sell something. You may want to consider trying to get it done before the end of the year. In fact, this one, as it's written now, will actually be effective as soon as the act passes, which could be, as expected to be, before the end of the year. So this is definitely something you want to watch out for, because just right off the bat, this is a 20% increase in your tax liability. So if you can take advantage of this 20% rate now, it's definitely worthwhile. The other one, and this one you might not have heard of as much, but it definitely affects a lot of people. It's been around for about a decade now, but this is the net investment income tax, or short, we just call it the NIT tax. Not neat, because it's really not. So the NIT tax, previously, this only applied to investment income. So this was typically your interest, your dividends, your capital gains. And if you were not a real estate professional, it could apply to your real estate income. But a lot of times, if you're active in real estate, and you're able to take advantage of some of the elections that are available to real estate professionals, you could avoid this tax. But what this is it's essentially another 2.8% tax on top of whatever rate that you're already paying. So this is either your ordinary income rate that you're already paying as it stands now, 37%, or your capital gains rate of 20%. You'd add on this 2.8% if you had income that was subjected to it. So the big change here that you want to pay attention to is it's no longer shouldn't be called net investment income tax anymore because it'll apply to real estate because it's going to apply to trades or businesses, which really this means operating businesses as well. You know, think of any retail store, dental practice, lawyers, you know, would potentially be subject to this if you hit the income thresholds. And so this is a big change for real estate and something to keep on mind. You have to budget for this increase. So when you hear the ordinary rates, the capital gains rate, know that you may actually be paying more than that. So definitely something to keep your eye on. The next one is what is referred to as the 20% deduction. Now the technical name for this is really the qualified business income deduction. And this was part of the Trump administration when we received those new set of tax laws. And essentially what this was to level the playing field for smaller businesses. So as you might remember, they had lowered the corporate tax rate from what it was previously to a flat 21%. So in order to give that similar benefit to the smaller businesses that are organized as partnerships or S corporations, which is a significant portion of the businesses as you're driving down the street are probably organized in that way. And that includes real estate. If you own rental real estate, a lot of times it's being held in an LLC that may be taxed as a partnership. And so you would get this deduction on your real estate income. And effectively, it had the benefit of lowering your tax rate. So if you took 20%, just essentially a fake deduction. Think of it as a fake deduction. Say you made $100,000, you'd get to deduct 20, even though it's not a real expense. You'd only get taxed on 80, which is the difference. So the change is that currently there's no limit to how big that deduction can be. Now there are other limits that may change, whether it is 20% or some other percentage, but there's no limit to once you've done that calculation as far as how big the deduction can be. What they want to do, or what's proposed currently, is limiting the deduction. So married filing joint is what MFJ stands for. So if you're married and filing with your spouse, you can only take a maximum deduction of $500,000. If you do the math, if you're maximizing it at 20%, that'd mean income of $2.5 million with a $500,000 deduction. If you're single, it would be a $400,000 maximum deduction under the new proposals. You may think those are large numbers, but it is going to hit a significant amount of people if it passes in this way. So this is just another way, in addition to the actual rate increases, that we may see tax rates increase indirectly. This last one is huge. This is the excess business loss. This was a new concept as part of the Trump administration also, but its limits are going to potentially get a lot harsher if it passes how it is. So let's just do a quick example of how this works. But essentially, if you have a W-2 wage, so let's say whatever profession you're in, let's say you own a dental practice, and let's say you take a wage of $100,000 every year, just to keep it simple. And then let's say you're organized in the business as an S corporation, then you would, if in any particular year you had a loss, let's say it was $50,000. Well, you used to be able to take this loss against your wages, so you'd only be taxed on the difference. You'd be taxed on $50,000, which is what you made, right? Well, the change now this year is that will go away. You won't be able to take this excess business loss. So because it's a loss, you would actually be taxed on your wage income only. And that's a big change. So what would happen here, you might ask, well, that would carry forward to some future year when maybe you generated some positive income for the business. So if this actually comes to fruition, there's a lot of planning that you could do around this. You may want to look at, before year end, what your wage number is so that you can get this number to be either positive or closer to zero if that's a situation that you're potentially looking at. So keep all these in mind. These are probably going to change slightly as they move through the process, but it was great talking to you, and I'll look forward to seeing you in the